Welcome back to the second part of our conversation on international tax planning. Again, we're going to cover today how to handle employee resources globally. My name is Chris Delcambre, and I'm a tax partner in the Cherry Bekaers Technology Group based here in DC. My colleague Raj Tripathi, who is Managing Director in our International Tax Services Group, and I have so much to cover on this topic that we needed to break it up into 2 episodes. So if you haven't already listened to our previous episode, which focuses on outbound issues, I encourage you to listen to that first. In this episode, we'll dive into inbound issues, which tend to be a bit more complex than the outbound piece. We're just going to pick up right where we left off, if that's okay with you, Raj.
Absolutely.
Let's move now to inbound, Raj. And that was a lot that we just talked about. We just covered the outbound. So maybe it's a good idea to kind of just give a refresher real quick on what the inbound meaning is. And don't worry, there is not a test after this. So.
Right. So I think the similar thing that we talked about from outbound perspective, if a foreign company is trying to expand their operation in the US, they have to follow the same strategy of understanding that, hey, what is my exit strategy when I enter the US? What type of legal entity I should be setting up in the US, and what is my permanent establishment risk when I have my employees moving from a foreign country to the US, or I'm hiring consultants in the US, or am I hiring employees in the US? So whenever a foreign company comes from inbound perspective to set up their subsidiary or a partnership or a LLC in the US, understanding and doing a feasibility study of the tax implication, my exit plan, and what are the different states, because US has 50 states. All the 50 states do not recognize a treaty, except the federal. You can only take the treaty benefits at the federal level, not at the state level. So you have to understand that what is the treaty and what kind of repatriation strategy I should have in mind. And in addition to that, let's say if the company wants to do an acquisition in the US, then you have to make sure that you have do a proper acquisition in the US by making it, is it possible to make a tax-free acquisition? Or whenever I do acquire a company in the US, whether it's going to be taxable acquisition. So that's something that you always have to do your due diligence and proper strategy and planning around that. And that's where we, Cherry Bekaers, can come and help you. But lastly, I will say that overall, the P is very, very important. And you also the tax treaty, because as I mentioned earlier, US only federal government will recognize the treaty. All the 50 states say we do not recognize the treaty. So any foreign company coming and doing business in the US all have to make sure that any P risk at the state level is mitigated, and you talk to your tax advisor, to how to mitigate that P risk, if any.
Yeah, definitely. And then, so staying with inbound here, so similar to outbound, but we're on inbound now. Similar to outbound, now inbound has both the employee and the entity type complexities associated with it. And so from an employee perspective, when a U.S. subsidiary of a foreign parent is established in the U.S., there's several obstacles to be aware of, as you can imagine. One of the biggest obstacles that we run into most of the time is that when this foreign parent establishes or purchases a U.S. entity, and then that foreign parent sends its employee, or especially this C-suite executive, to the U.S. to help oversee the initial opening of this new C Corp in the U.S. or the running of it or maintenance, whatever it may be, that becomes problematic in some ways, and it needs to be looked at. And I think maybe an example here is best. And I know, Raj, again, you and I have a client that does this, with a large manufacturing client based out of another country, subsidiaries in several countries throughout the world. The client. And so that parent corporation will send employees to the U.S. And needless to say, that comes with a bunch of different structuring opportunities and reasons to be careful about how you're establishing permanent establishment or how that employee is treated in the U.S. And I think you're definitely the best person to speak to this and talk about how employees coming from a foreign parent to a U.S. sub, especially when we're talking about the C-suite executive, kind of the hurdles and pitfalls that come along with that.
No, absolutely, Chris. I think this is one of the key things in the permanent establishment space that I've been talking about. And this is the reason why companies, when they do cross-border, expansion, whether outbound or inbound, they should understand that when they're moving their employees, what cost is it coming to when you move employees, and specifically when you're doing the C-suite level executive, when they travel. And in our case, you talked about, an example is where in fact, I have a client right now. They're headquartered in Canada. They have a sub in the US, but the C-suite level executive is traveling on a regular basis to the US. And we have kind of advised them that, hey, when the C-suite level executive is coming over here, they're creating a P risk for the Canadian company in the US. And what that means is that the C-suite level executive is coming here, traveling to different states, meeting clients, making decisions, and therefore the risk is that the Canadian company will have to start attributing the salary of the C-suite level executive, the sales and marketing that the C-suite level executive is doing over here. That attribution will get triggered. They have to attribute that income and the profits into the US and pay taxes around that. So be very careful around this, that whenever you are at the C-suite level executive travels to the US on a short-term basis, or even makes 4 or 5 trips in the year, they should be mindful of what that person can do and how they should be reaching out to their tax advisors to mitigate the issue of P. So that's the first thing on C-suite level executive. But the second thing is, a lot of companies will send, and the same client that I'm talking about is sending people on a short-term basis to come into the US for a couple of months and then go back. And that's where we have advised the client that they cannot do that unless and until you decide to use a third-party firm in the US or have some kind of a secondment agreement. What that means is there's an interfirm agreement, interfirm transfer of the employee from the Canadian company to the US, and the salary is cross-charged by the parent company to the sub. The employee then moves from the parent company to the sub, and the salary is borne by the subsidiary on behalf of the parent company. And that employee who he or she is doing the interfirm transfer coming to the US on a short-term basis is working on the US payroll. So this will mitigate the P risk significantly for the company when they're doing this kind of an arrangement on a short-term or long-term basis. And they don't want to use a PEO firm on a short-term basis. That's something that we should be very mindful of, that any employee C-suite level executives coming, please talk to your advisors, make sure you're properly putting your checks and balances around it to mitigate your P risk. And also keep in mind, which I mentioned earlier, that the 50 states in the US do not recognize a tax treaty. And the tax treaty does say that, hey, if the employee or a person comes to the US and for 90 days or less than 90 days, you don't have a P risk, But then the moment you cross the 90-day threshold, there is a P risk. And then there is a domestic law in the US as well that we need to look at the 183 days of preceding 2 or 3 years, So all this test needs to be determined, but that's only on the federal level. The states do not recognize that. All the 50 states are going to say, hey, we don't recognize a treaty. That C-suite level executive is coming over here. That employee is coming to my state. Make sure you have proper withholding. You file your returns properly at the state level. Pay all the withholding taxes from FICA, FUTA, Social Security, because that's not something we recognize. The treaty is something we do not recognize. So keep in mind, this is very important. We have to reach out to our, clients, that whenever they're moving the employees on a C-suite level executives, they should mitigate the P risk by reaching out to our, your tax advisors. And lastly, I'll say that whenever your example that a foreign company is coming to the US and they are basically setting up, a subsidiary, and they then go ahead and have set up another branch in a foreign country from the US, then we have to make sure that you are filing proper returns in the US of the subsidiary and the branch below that. And whenever you hear branch concept, a branch is a very complex thing. I always advise my clients not to set up any branches or put any kind of a structure around a US subsidiary, especially from inbound perspective. That is a branch in a foreign country, because the reporting requirement becomes cumbersome. And keep in mind that the foreign company having a subsidiary in the US, you have proper transfer pricing in place, because any intercompany or transaction or reportable transaction between the parent company or the US sub, because a US sub is held 25% or more by a foreign parent, there's a filing requirement, and any reportable transaction needs to be reported by filing a 5472. and not having proper transfer pricing in place for the reportable transaction and not filing the 5472 correctly, the statute of limitation is open and the IRS can come and levy penalty, and the penalty is $25,000 per year of non-compliance or non-completion of the 5472. So that's why I always tell my clients, please be mindful whenever a foreign company is coming to the US to set up a subsidiary, do business in the US by way of a subsidiary. Please make sure you're doing proper compliances, reporting everything correctly, and analyzing your PE risk.
Yeah, and Rod, this is something I cannot stress enough. I mean, we see this all the time. It's definitely big in this area, and as you alluded to, with the $25,000 fine, it is very expensive. And not only that, I mean, it can be $25,000 per form. There's penalties associated with the employees withholding. I mean, it really can become a huge problem very quickly for something just somewhat we would think was mundane or a normal business practice. And so, for those in the audience who have not dealt with this or seen this, I cannot stress enough to, if something like this occurs, the first thing to do is to reach out to Raj or Cherry Beckert and our team, because I can guarantee you that this discussion and Raj particularly just saved you a ton of money, not to mention probably an immeasurable amount of time and headaches and probably an ulcer or two, I'd say.
Absolutely. I think we have to make sure that anytime you're doing any outbound, inbound, hiring any consultants in a foreign country or any consultants here in the US, having a global expansion plan from US outbound perspective or inbound perspective, please reach out to your advisors, reach out to Cherry Beckert. We are here to help and support you. And we have been helping a lot of technology clients, helping on their IP planning, P risk, movement of their employees, something that we can help and support them.
Yeah, and that's good advice, right? And just to reiterate that, I mean, as soon as an owner, a CEO, CFO, controller, anybody starts to hear about foreign employees or entities, the best practice is to reach out to Cherry Beckert and Raj and his team just immediately. In the perfect world, Cherry Beckert, Raj, and his team, we would be involved with this from the initial kickoff, the planning part. As soon as we hear about foreign employees or foreign structures or inbound or outbound, we want to be in there at the beginning. Obviously, in the perfect world, that works out great. But if the situation doesn't allow for that, if historical decisions have been made or things are already in the works, it's still okay to call. We work through this all the time, but it is easier if we can implement it from the very beginning. Again, Cherry Beckert, we're here to help. We do this a lot. We can take as you can tell, there's some complexity here, if not a lot. We can take a lot of that complexity, if not all of it, out of this equation. I hope that everyone enjoyed this discussion and were able to take away some valuable points and ideas. Feel free to contact myself, Raj, or anybody at the Cherry Beckert team. Our information can be found at Cherry Beckert's website, which is cbh.com. Thanks again for joining, and we'll see you all next time.